So good afternoon. What a terrific first half of the day. Sometimes capturing lightning in a bottle is not the easiest thing to do, but nothing like a little market volatility and anxiety to get people to come out and look for guidance and compare notes and see what other people are doing. But I think that it certainly felt that way in the first half, and I think the second half is going to be as well. So thanks all for coming out. I am Van Hesser. I run our corporate and financial institutions ratings business at KBRA. I'm delighted to be here today, and my distinct pleasure to introduce our next keynote speaker, known to, I think, everyone in the room, Professor Ed Altman, the Max L. Heine Professor of Finance Emeritus at NYU's Stern School and Director of the Credit and Fixed Income Research Program at the Salomon Center here. So Ed and I got to know each other over the last couple of years as we at KBRA began discussing really a strategic partnership with him that ultimately led to the arrangement that our pal talked about this morning. As I got to know Ed, there was something that I struggled to reconcile. So how this man with the sunniest of dispositions could draw great intellectual satisfaction from the world of corporate bankruptcies and distressed debt. But that's Ed, right? Internationally renowned reputation on all things credit. Creator of the Altman Z-score, which is currently celebrating its 50th anniversary. Named laureate by the Haute Étude Commerciale in Paris for his accumulated works on corporate distress prediction models. Awarded the Graham and Dodd Scroll by the Financial Analysts Federation for his work on default rates and high-yield corporate debt. Founding executive editor of the Journal of Banking and Finance, and serves on the editorial board of several other finance scholarly journals. Professor Altman was inducted in the Fixed Income Analyst Society Hall of Fame in 2001, elected president of the Financial Management Association in 2003, and a fellow of the FMA in 2004. Ed's chairman of the Academic Advisory Council at the Turnaround Management Association, and was among the inaugural inductees into the TMA's Hall of Fame in 2008. This is his short bio, by the way. Ed named one of the 100 most influential people in finance by Treasury and Risk Management magazine, frequently quoted, as you still see, in popular press and on network TV. Ed has been an advisor to financial institutions too numerous to mention, but including Merrill Lynch, Salomon Brothers, Citigroup, Concordia Advisors, InvestCorp, Paulson and Company, and the list goes on. Currently advisor to Golub Capital, Classis Capital in Italy, Wiser Funding in London, Clearing Bid, SREI Capital in Singapore. If you're picking up a theme here, Ed loves to travel. ESG Portfolio Management in Frankfurt, and Alpha Fix in Montreal. He serves on the board of Franklin Mutual Series and Alternative Investments Funds. Ed was a founding trustee of the Museum of American Finance and was chairman of the board of the International Schools Orchestras in New York. A true Renaissance man, as I've got to know him over the last, again, couple of years. Please join me in welcoming Ed Altman.
Thank you so much. That was great. Thank you so much, Van, and thank you all for coming back after lunch. I know it's easy to leave after lunch, so I appreciate that very much. Before I talk about what I'm supposed to talk about here, I thought I'd tell you a true story. It's an anecdote, but it's a true story. But I didn't plan to until the fire drill this morning. So I don't know, some of you weren't there earlier, but about 10 after 9, quarter after 9, the lights flickered and alarm went off. And as Eric Rosengren said, everybody thought about should they leave or not. Well, this is a story that is somewhat of a parallel to that in a number of ways. A true story. Some of you may remember last January, there was a missile alert in Hawaii of incoming missiles from North Korea. And I was in Hawaii at that time. Every January, my family and I and friends go on a retreat in Hawaii. And I've been honorary inducted into a group called the Romeos. Stands for Retired Old Men Eating Out. And we were eating out for breakfast at a diner in Honolulu. And everybody's cell phone started beeping and honking and whatever, that there was a missile alert and that everybody should seek shelter in some way. Well, the Romeos, average age is about my age, almost 80. And, well, we've lived a long time and a decent life. So none of us moved. And one guy asked me, what do you think we should do? And I said, do they have any vodka? And unfortunately, this diner did not have vodka. Meanwhile, people were running in and out saying, do you have a cellar? No, they left. So we were there, and then I think the most interesting comment was from one of my sidekicks in the Romeo group. And he said, maybe we should wait to pay the bill. True story. And then finally, you know, the all clear came 39 minutes later. That's a true story. And it was like a lot of people didn't get up this morning when the fire alarm came off. I have another story to tell, but I'll wait a little bit, and it's another true story about what happened in 2007 when a number of us were predicting the financial crisis. We didn't know when it would take place, and we really didn't know what would be the catalyst, although there was a lot of indication it was going to be the mortgage-backed securities area. But I'll wait for that anecdote a little bit later on. What I would like to talk about is kind of very much related to the theme of the conference, and that is where are we, or where we are in the credit cycle, and a little bit of outlook. Now, I was really interested to listen this morning to so many of the great comments from the panelists and from Darryl Duffy and Eric Rosengren. Although I must admit, except for Kim's question about what do you think is the likelihood of a recession in the next 12 months, they were talking more about the resiliency of the system and the safeguards and the fact that there's a lot of risk in the system, but things are different than they were last time with all the safer situation in the banks, although the rest of the world seems to be going in the opposite direction. We're kind of okay in the US. Well, first of all, I don't think if the rest of the world goes to hell that we're okay in the US. I mean, it doesn't work that way in the world economies. But also, the question very much is, what's the likelihood of a recession, whether it's in 12 months or 24 months or even longer, and then what will be the consequences? It really doesn't matter except for the election, whether or not it's in the 12 months. That's an important one, but it isn't what is going to shape what happens once we have a recession. So I want to come back to that theme as well. Now, some of you may know that I've been around a long time, and particularly I was very fortunate back in 1982 to be asked by Morgan Stanley at that time to give them my opinion about, and indeed to come work for them. And I was contemplating all the extra zeros in my salary, but I decided to stay at NYU. But they hired me to do a kind of a consulting, whether or not they should get involved in this new market called high-yield junk bonds. And some of you may remember back in 1982, it was a tiny market, $10 billion, mostly fallen angels, and Junk was, of course, the acronym used. But the earmarks were there of a growing market, mainly pioneered by Drexel and a few other investment banks. Michael Milken, of course, you probably have heard and read about him. And I was this little professor who was asked to comment for a major bank because they were thinking of getting their hands dirty, if you will, with junk bonds. And the market was $10 billion. Well, we did a couple of studies on default rates, rates of return. The thing that was lacking up to then, as is so often in new markets, is data. And with data, you can do analysis. Without data, all you can do is speculate. And so data is really king in so many ways. And so we did the study. And ever since, I've been following the high yield market, defaults, returns. As Van said, I do get a great deal of delight when there's a big bankruptcy or two or three. My wife and I have this tradition of opening up a bottle of fine red wine every time there is a big bankruptcy. And we go to the fine champagne when there's several in a short period. And in some years, like 01, 02, and like 08 and 09, we're drunk all the time. So, it's a wonderful situation with respect to analytics. I mean, you need data. It's, a bit of a joke that, it's the dark side of finance, but it's so much more important than the upside in terms of studying it and trying to predict it and avoid it if necessary. And that market has grown. Today, 1.7 trillion in the US. My number is a little higher than the other rating agencies and maybe some of the investment banks that follow it. But I think we're pretty close to being right, about 1.7 trillion. In Europe, about 500 billion euros. Rest of the world, about 2.8 trillion, almost $3 trillion in leveraged finance, high yield bonds and leveraged loans, about 6 billion globally, maybe a little less than that, but pretty close to 6 billion, and that's just lower quality. Now, the reason why I emphasize the lower quality part of the market as opposed to the entire market, although we are going to get to the entire market a little later on, is because most, but not all, defaults emanate from the non-investment grade class of markets. Yes, occasionally an investment grade company does default, like Lehman Brothers, John Mansfield back in the 80s, most recently the big utility, Pacific Gas and Electric. But most of the defaults come from BB, B, and CCC. And so it's really important to study that market. Most important with respect to today is metrics to measure where we are in the credit cycle. And that's what's going to be my focus today. The benign credit cycle we are in, most people would certainly agree with that, if not everyone. Is it over? The answer is no. It is not over. We're still in it. But the question really is, when will we know that we are no longer in it? It's one thing to know where you are. It's another thing to know when you've changed. And so the only way to do that, in my opinion, is to have metrics for measuring where we are in the credit cycle. So we're going to talk about 4 metrics, and then I'm going to give my opinion about the outlook and my concerns with the credit cycle, and when it ends, what will be the consequences. And we're going to talk about the second bullet in particular. Those are the 4 areas. And here's where the issue is very much related to this morning's discussion, and probably what's going to be talked about in the panels in the afternoon, and that is, how does the credit cycle relate to the real economy? And vice versa. How does the real economy interact and correlate with the credit markets? It's not as easy as most economists would argue, I think. So let's talk about the 4 variables, the 4 metrics that I look at to determine where we are in the credit cycle. Let me give you right now what they are. Default rates, recovery rates if there are defaults, yields and spreads required by investors, particularly in lower quality debt, the more risky debt, and finally, liquidity. Default rates, recovery rates, yield spreads, and liquidity. If all of them are pointing in a benign cycle way, we are clearly in a benign cycle. It's not clear how many need to signal the change, but certainly several of them need to be, if not all 4, need to change from a benign to a stressed and maybe even crisis scenario. So let's talk about those 4. The first, and by the way, all our slides will be available on the Salomon Center and KBRA website, along with, it's being recorded, so you can see this video as well as discussion. As many of you know, we calculate at the Salomon Center, and we'll be doing going forward at KBRA, default rates. And it's the default rate in the high yield market that we are focused on. And we're not the only one. The rating agencies, the other rating agencies all do it. Some of the major investment banks do it. And they report it on a almost real-time basis. So we know about default rates. And we define defaults, of course, as bankruptcies, missed interest payments, and not cured in the grace period, and finally, what's called a distressed exchange, which I won't go into all detail, but it's the most ambiguous and contentious of the 3 measures of defaults. And so the second column or third column there talks about the par value of defaults relative to the amount outstanding. And let me just give you some summary statistics. Over the last 40 plus years, the historic average default rate for high yield bonds on a weighted average basis, 3.3% per year. So why not use that 3.3% benchmark as an indicator of when the cycle is possibly changing from benign, below 3.3, to stressed above? And what's a crisis? Well, you ask someone, what's a financial crisis? And they'll say, we know it when we are in it. But that's not very helpful in terms of measuring as you're approaching it, and when and if it will happen. So I define it, and this is arbitrary, as 2 standard deviations above the mean. The mean being 3.3, standard error about 3%. So we're talking about a 10% default rate as a crisis period. And it turns out that unlike statistics, which says there's a 2.5% probability of a 10% default rate happening because it's 2 standard deviations and the tail of one of those parts of the distribution, 2.5% would be a very small probability. But it turns out over the years, and these are the last 3, we've had already 5 years of more than 10% default rates. And they are given in this chart here, 1991, 01, 02, and 09. The last one being the so-called Great Financial Crisis. By the way, you know where that name came from? GFC? Of all places, Australia. And the irony is they never had a crisis. So it's your crisis, and they called it the GFC. That's where it all started. It's interesting to say. Okay, now, it's interesting to notice in between the peaks in the default rate, we have benign cycles. And you can actually see this better on this chart. So this chart correlates, or shows the, it's not a formal correlation, but shows the trends of the difference or the amounts of default rates, that's the line graph, these guys. And the yellow bars represent economic recessions in the United States. And we're very fortunate in the United States to have lots of recessions and lots of bankruptcies and lots of defaults. Really fantastic if you need data. And a lot of people borrow our data, first of all, because it's available. And secondly, they say, well, maybe we can use their experience to to figure out what's going to happen if we have a recession, like Australia. Those poor folks in Australia, they haven't had a downturn since the 90s. I mean, how the hell are they going to figure out loss given default if they have no data? So they have to borrow our data. So what's great is you can look at the benign cycles, 5 years, 7 years, 7 years, 4 years. And now, ladies and gentlemen, you can all, and you probably know this, we are more than a decade into the latest benign cycle. By far the longest that we've ever had. The average benign cycle is probably about 6 years in the post-World War II period, and now it's over 10 years. Now, that doesn't mean it's going to end next year or the year after, but it certainly means that we're probably in extra innings. And you know, in extra innings, the only time you get there is when the score is tied, and the score has been tied for now 2 years. And I thought perhaps we were coming out of it here. The benign cycle was about over. That was the energy crisis. That was when China was having some problems, a lot of problems, which miraculously have been solved. And it also was when oil prices were $30 a barrel. And then miraculously, we had some wonderful events taking place, for some people anyway, wonderful, when all of those problems were solved. The price of oil went up. QE started in the 4 major central banks of the world. That's when, by the way, central banks had a lot of ability to impact the credit cycle. That's when interest rates were much higher, and so lowering interest rates aggressively and consistently worked. And the stock market turned around, and the stock market is really important. I was surprised nobody mentioned the stock market this morning as an impact on the credit cycle. It's an incredible impact on credit. And we all know in corporate finance that you measure leverage many times, not in book value, but in market value terms. And the market value of equity is a very good indicator of the confidence of the markets. And when that changes, which can happen very quickly, along with liquidity, then you have big changes in the credit cycle. But notice in this relationship that in some years, the default rate actually starts rising several years before the economic recession. And you don't find too many economists talking about that maybe credit issues are a forecaster of real economy moves. It's usually the other way around, and that's absolutely true. If we have a recession, there are going to be more defaults. You know, firms have much less ability to cover their interest payments. The cost of capital goes up, both debt and equity. Take a guess, what is the correlation between equity prices and risky debt prices, particularly since the great financial crisis? Well, if you do that analysis, the answer is above 0.7. And before the crisis, less than 0.4. So there's been a secular shift in the correlation between risky debt prices and risky equity prices, which means they move together. And if they move together, it means you can't hide by switching from one to the other, as we used to teach in corporate finance in terms of the opportunistic theory of debt structure. So getting back to this relationship, one of the takeaways from our analysis is, I don't know if it's next year or the year after, but when we have a recession, we're going to have a spike in default rates. And nobody would argue with that. The question is, will there be a signal that default rates are rising and above the historic average before we have a recession? So therefore, one of the metrics I think we should look at in determining the likelihood of a recession is what's happening among defaults. And what is happening so far is the following. If you look at the upper left-hand corner, we see 2019. That's not yours, is it? That's yours. Okay. Thank you very much for the music. So far this year, through the end of August, so it doesn't include, by the way, Purdue Pharma is not going to add to our default rate because mainly their debt is private. I don't think they have, these are all public bonds, high yield bonds rated non-investment grade. So far, through August, 1.7% year to date. We extrapolate that for the rest of the year, around 2.4, below the average of 3.3. So I'm pretty sure we're going to end the year at below average default rates. I don't think anybody's forecasting above average. The other rating agencies, Goldman Sachs, Morgan Stanley, JP Morgan, are all forecasting less than 3.5% default rates. My forecast, by the way, for the next 12 months is 3.2% high yield bond default rates. Again, just about the historic average. And so we're below it, but inching up. By the way, if you added Pacific Gas and Electric to the data, it would be 2.7%. Now that's contentious. I'm the only one, I think, that has an asterisk next to default rates because PG&E was a junk bond on January 8th, and they defaulted on January 28th. But they were forecasting the default, and most people say because we knew they were going to default, it really was not a junk bond default rate, it was a investment grade. So I have it both ways. So let's take a look at the other three metrics. So far, we are below the historic average and are likely to be there by the end of this year. Oh, here's my forecasting technique. I look at yield spreads. I look at the distress ratio. For those of you who are not familiar with the distress ratio, I think it's an incredibly important measure. It's the percent of high yield bonds trading at 1,000 basis points over the, quote, risk-free rate in terms of the option-adjusted spread, or the yield to maturity. It's more or less the same thing. This was a metric that I thought up in 1990 when someone asked me to look at the distressed debt market. It was a firm called the Foothill Group, which is now part of Wells Fargo. And I said, well, what is a distressed debt? And they said, you know it when you see it. I said, that's not good enough for the data. So we devised this 1,000 over treasuries. And so today, I don't know, what is it, 1.7% or so, the 10-year rate, or the option-adjusted rate, something like that. So it's about 11.7%. Yield anything above that is a distressed. The percentage of distressed of high yield has a 77% R square in predicting next year's default rate. Very simple, bivariate analysis, and you can explain next year's default rate with not total accuracy, but pretty high accuracy with just one variable. Put them all together, the three metrics come out with a 3.2%, that's the right-hand column at the bottom, average of the models we look at. We look at mortality rates, which I don't have time to go through with you, as well as the yield spread, around 3.2%, which is just about the historic average. So that's our forecast. Recovery rates. We talk about loss given default quite a bit. But what is loss given default? Well, it's how much you lose. But how do you measure that? Well, there are three measures that are out there in the markets. One is the price of defaulted bonds and loans just after default. This is the one I use. It's the easiest, most transparent metric, and it's also very much immediate to what you could sell those bonds for or what you can buy them if you're a distressed investor. If you're in the CDS market, it is the 30-day auction-determined price. And if you're a banker or many others, you look at what's called the ultimate recovery, which is the price of the debt or the value of the exchange at the end of the restructuring period, which is usually the end of the Chapter 11 period. And so we look at the price just after default. And so this is just an example. Default rates are in the second column over the last 5 years through the second quarter of 2019 only. The overall recovery rate is the weighted average price at the time of default. And notice that it varies too. Well, you know, there's a very simple relationship between default rates and recovery rates. And it's given by these regressions. And these are very simple bivariate relations, linear and nonlinear, between coincident default rates and recovery rates. And I published a piece with a couple of wonderful Italian researchers back in the early 2000s. It actually was published in the academic literature in 2005 of this correlation between default rates and recovery rates. And those are given by the 4 equations up there, but just to summarize for you, there's a highly significant negative relationship between default rates and recovery rates, which means if you have a very stressed period of high default rates, coincident with that, you're going to have a very stressed period of recovery rates, low recovery rates, which means LGD is going to be hit twice, high defaults and low recoveries. Up to our piece, banks were estimating LGD for Basel purposes based on historic average recovery rates. And it became pretty obvious that you shouldn't use averages. You should use correlations between the 2 main metrics that determine LGD, which is a highly negative relationship. And so if we forecast next year's default rate as 3.5% up here, we go up here and we come across, and we're talking about mid to high 40% recovery rates on bonds and probably 60 to 65% recovery on loans. And that should be factored in to investors' expectations. And investors' expectations are identified. Oh, let me just conclude then on this. The current year-to-date default recovery is 49 cents on the dollar. Historic average, 46. We're just about at the average. Okay? We're not quite in a stress cycle. We're coming out of the benign cycle. The benign cycle said would be less than 46 cents on the dollar for bonds, and we're at 48. So it's slightly benign, but getting close to the historic average. So that's the second metric. Still benign, but creeping up. Yields and spreads. This is a familiar graph to many of you. It shows the historic required rate of return of investors in high-yield bonds in terms of the yield-to-maturity spread and the option-adjusted spread. The option-adjusted spread is the one that I guess most of the market practitioners use, but I like to look at both of them. And back here in June 12th, 2007, the lowest spread in the history of mankind. That was risk on. Anything could be floated. So here's the anecdote that I promised you that I say before. I was giving this talk up in Montreal for the North American division of a large French bank. It was Société Générale. And at the end of my speech, which was forecasting a big financial problem coming in 2008 or 9, I didn't know when it was, but I was looking at the corporate market. I wasn't smart enough to figure out that that wasn't going to be the catalyst. And at the end of my speech, the president of the bank came up to me and said, you know, Professor Altman, that was a really convincing argument. If I understand you correctly, that we are in for a lot of financial problems, I should be reducing exposure, maybe hedging, or even selling short credit, probably through the CDS market. I said, oh, that's great. Thank you very much. That's very flattering. He said, yeah, but I don't have the courage to do it. I said, what do you mean courage? If you are convinced that it's the right policy, why won't you do it? He said, well, you don't understand my job. And I said, yeah, you're probably right. That's why you're a bank president, and I'm a college professor. And he said, no, I'm serious. You don't understand my job. I said, well, what do you mean? He said, well, listen, if you're right, and I follow what you say, and the market goes to hell, and I've been hedging or going short, I'm going to be a hero. and get a big bonus. But if you're wrong, and I follow what you said, and I jump off the speeding train while it's still speeding and people on board are dancing and having fun in the benign market, I'm going to get fired. So there are a lot of smart people out there, and there were then, that didn't have the courage to get off the train when the market seemed to be pointing in a very stressful way. Now, soon after that, the spreads went from 260 to 2046, 20.5% spreads. You look back and you say, it's impossible. But it was possible, and that's what happened then. You couldn't do anything in the credit markets. Trade came to a halt. We were in the GFC. Fortunately, it didn't last long. Now, the Fed, you heard with Eric this morning talking about rising interest rates or lowering interest rates and the dynamics of making that decision. But then, if you remember Ben Bernanke and what they did, is that they finally woke up. With all due respect to the Fed, sometimes they don't move proactively. They move reactively. And that's what happened then. And they pumped enormous amounts of liquidity into the system, and it worked. It really worked. But there was a lot of pain until it worked, the GFC. If they had moved earlier, there's no question there would have been less pain, and those spreads never would have gotten to over 20%. So now maybe they've learned from that a little bit, and they are proactively, but don't forget, they're lowering interest rates at a time when almost all the metrics saying we are still in a benign cycle. And will they have any ammunition when the situation changes? And so spreads came down dramatically within a year back to the historic average. Historic average spread, 5.2%. 5.2% spread is the historic average of high yield versus treasuries. This is Italy in 2011. This is the oil crisis here. But for the most part, it's been at or below the historic average. And today, well, this is 831.19, 490, 489 spread. The spread this morning is 454. So 4.5% spread, historic average 5.2. We are still in a benign cycle and are likely to remain that way for some period of time. We don't know how long, but certainly it looks benign. And finally, liquidity. Now, my colleague Jakob Ammerhut is here, and he's really the guru of liquidity. However, liquidity that we're talking about is not individual firm liquidity in terms of measuring bid-ask spreads and things like that, and volume, et cetera. We're talking about liquidity of the markets. And that is very, very difficult to forecast, especially a change. Because I think, as Charlie and others had said this morning, liquidity can change really quickly, almost overnight, if you have an event happening like some of the liquidity issues that happened just this past week. And a number of people have talked about the repo market this week. And so how do you measure liquidity of markets? Well, I don't know any perfect way, and this is not really an area of my research, but what I look at, it's a very simplistic measure. What percentage of high yield bonds are being issued at CCC rates? If a ton of CCCs are being issued, as they were in 2007, when 37% of the high yield market were CCCs issued in that year, then it's risk on, risk on, risk on. Now, it's a lot less. But it was pretty high, 24, 20, 26, not too long ago. And so there's a lot of risk out there, and it's still outstanding. It's still CCC. The new one, maybe the markets are getting really concerned with the possibility of the next crisis or next distress. And so in the US today, it's dropped to 13 and 8. But look at Europe. Europe, 21, 26. the quest for yield, and you get yield with triple Cs. Guess what the historic cumulative default rate is for 5 years after a new issue triple C? How much? 25, I hear? Do I hear 30? Do I hear 35? 50, wow. Charlie, 60? Sold, by the way. 47.4%. Now that's historic data. Within 5 years of a triple C, almost 1 in 2 will default. And yet, in big liquidity years, triple Cs are, a third, maybe even more of the high yield market. How could that be? Who would buy a bond if they knew that half of them are going to default within 5 years? Well, of course, that means half don't default. And also, most managers say, oh yeah, but I'm going to get out before, right? Like running for the exit at the same time. Well, we know that that doesn't work for a lot of people. And of course, triple Cs are easy to measure. And yes, we can talk about rating standards from rating agencies. Has that changed? But still, we look at that, and I see more risk concerns, not more risk now, because that's happened already, in this fourth measure. But to conclude, all of the measures at this point are pointing to we are still in a benign cycle. So the question is, what happens when that changes? So let's move to concerns about the benign cycle. We've talked about the increased leverage in the system. Well, here's some data. At the end of 2018, there were $9.3 trillion of corporate debt, corporate bonds in the US, of which 7.7 were investment grade and 1.65 were high yield. These are bonds. And a tremendous increase since 2007. It was 4.2, now it's 7.7 investment grade, mainly triple Bs, and it was 1.08, now it's 1.65 in 10 years. That's a 10-year increase in leverage, and that's just bonds. Now loans is not as dramatic of an increase, because the Fed is very observant, and they're looking over the shoulder of the banks in terms of making those triple C, debt to EBITDA ratios greater than 5, et cetera. But the banks are jealous, that the markets are taking a lot of the play away from them, and they're making a lot of these cov-lite loans. They're making a lot of these loans, and of course, they're being funneled directly into CLOs. So Oleg is in the next, Oleg Manantalev from Bank of America Merrill is going to talk about leverage in the system also. And I think their latest number, and I called them up 2 weeks ago, and I asked them what it was, is $640 billion of CLOs in the US. And if you add what's out there in other parts of the world, it's a huge market. And of course, there's the moral hazard issue of CLOs. And of course, there's the reputation issue. But that market, which has performed pretty well in the past, is growing a lot. And I think Mark Carey and Victoria are going to say something about that in the next panel. This shows the triple B percentage. Triple Bs used to be 30, 35% of investment grade. Now they're 52%. Huge increase. $2.5 to $3 trillion increase in triple Bs. So who is really concerned with triple Bs? They're not going to default, right? They're investment grade. My concern with triple Bs is the crowding out effect. If 10%, 20% of triple Bs get downgraded to double Bs and Bs, what's going to happen to the triple Cs in terms of refinancing? That's what my concern is about the triple B phenomena, which is growing dramatically. And corporate treasurers, I don't know if we have any in the audience, they love triple B, right? They love triple B because they're still investment grade, their cost of debt capital is really low today, and they're piling on. And so it's risk on. The question is, what are those companies going to do when the cycle changes? Well, in the past, they could always issue equity. That's not so easy when the correlation is as high as it is between the two. This is a very important one of the last ones. Frank, I've lost track of time. Oh, I'm okay. I think, well, since I'm running the session, I guess I'm okay. This is a really important graph. You may have seen it before. We created it about 2 years ago because we've got the data to do it. And others do now as well. The blue line represents non-financial corporate debt as a percentage of GDP in the US. So it's a measure of debt to cash flow. Not perfect, but it's for the economy as opposed to an individual firm. And we have 1 peak, 2 peaks, 3 peaks. The red dotted line represents default rates on high-yield bonds. 1 peak, 2 peaks, 3 peaks. The 3 peaks of corporate bond defaults every time came within 12 months of the peak in debt to GDP. And now, we've got a new peak. Non-financial corporate debt as a percentage of GDP. But look at the default rates. They're benign. What's the risk? Well, markets are very short-term oriented. They look at what happened yesterday, or last week, or last year. They don't necessarily look at what happened here, and here, and here. But what happened all those other times, sorry, it's not moving as quickly as I'd like it, were recessions. So every time we had a peak in default rates, it came very soon after the recession. So the question that Kim asked this morning, and I was really kind of interested in the response from the panelists. What do you think the default rate will be in 12 months, was his question. Remember that, for those of you who were here? And the answers were 60%, 30%. Charlie, was yours 30? 30, and I think 40 or so was Dave's. And one thing I was surprised is that they were painting a pretty positive picture about the economy and the credit cycle. But 60% or 40% is a pretty high probability, and that's just 1 year. And if you go 2 years out, the numbers are going to be higher, obviously. And I would guess that most economists today think that the likelihood of a recession within 24 months is well over 50%. Now, I'm not a practicing forecaster of the economy. Someone once said, never forecast. But if you do, never put it in writing. But if you do it frequently. And when you think about it, that's what most forecasters do, especially frequently. And so in the last week or two, especially with the Fed lowering interest rates a couple of times in the last couple of months, maybe those forecasts for the recession have diminished because the Fed is being proactive. But it's going to happen, whether it's 12 months, 24 months, 36 months. And if it happens, then we have to look at what's going to happen to default rates. And look at how much debt's out there. And this is just corporate bonds. What about non-bank debt? So Oleg is going to tell us how much non-bank debt is out there. Where are you, Oleg? There you are. Can you give me a number? Non-bank, approaching $1 trillion. This is not a trivial amount. And if you look at what's happening in China, it's also a huge percentage. And so when we look at this corporate bond relationship with default rates, what about non-public debt? Now, I was speaking to my friend Beatrice Mitchell this morning, and she pointed out something very correct. She said a lot of that non-financial corporate debt is issued by private equity firms, issued by companies that are owned by private equity firms. And a private equity firm has a much greater staying power than the average company does by itself. And so they have skin in the game, and they may be pumping money in to reduce the likelihood of defaults, but it's not going to work across the board. It's going to work for some, and some of them are going to say, bye-bye, I can't keep throwing good money after bad, especially if the recession is a longer one as opposed to a short one. And so this relationship really should be amplified to be involved with public debt as well as non-public debt. This shows net debt to EBITDA. We're at a very high level historically, again, consistent with the amount of debt. Final 2 slides. Let's go to global situation. What I also was concerned with the discussion this morning, by the way, this discussion this morning was fantastic, but there were some things that I think we have to question. Because most of the commentary this morning was about the United States. And the United States, they're saying, banks are healthier than they were before. There's lots more equity in the situation for financial institutions. Companies' stock prices are very high. And if you measure leverage with market value of equity, the leverage ratio is not so bad. And so the conclusion was, we're in a good position in the US. And as a result, there's not as much to worry about. But what happens if there's a huge hiccup in China? And I'm not saying there will be, but there's no question that China's growth rate is falling, and it's probably below 5%, real numbers, even though the published numbers are higher. And what happens if Europe, which is clearly going in the wrong direction, continues to go that way, and if we have more geopolitical problems in the Middle East and other parts of the world, so the rest of the world is going to have a lot of problems. Maybe that's okay because we're so solid. But the world is not so disjointed. And if there are big problems in Europe and there are big problems in China, it's going to mean big problems here because we sell to them and we buy from them. And investors are spooked by problems in other countries. I mean, why did our markets go up so high in terms of required rates of return when Italy was in trouble? Who cares about Italy? Well, we all care about it, the pasta and it's a great place to visit. But from a world standpoint, it's not too important. Yeah, they got a lot of public debt, but it's mainly owned by themselves, banks and individuals. So who cares about Italy? But we were concerned broader than Italy. We were concerned with the euro imploding. And I think we're concerned with that again. The ECB is concerned with it. It's pretty clear what they're doing. And so we should be concerned with what happens in the rest of the world. This shows the growth in debt in the 4 major sectors of the world: debt, non-financial corporates, government, financial sector debt, and household debt globally. So this is 20 years ago, 10 years ago, 2007, sorry, not 22 years now, 12 years, 2007, and 2017, 2018. So non-financial corporate debt globally was 64% of GDP. Now it's 92%. Government debt was 58%. Now it's 86%. Financial sector debt, 53%, but the big jump, of course, was prior to the great financial crisis when it was 86%, and it's the one bright spot. It's now 80%. Even though the dollar amount is higher, the relationship to GDP is lower, and that is the bright spot. And banks are, no question, healthier than they were in '07. And then finally, household, 42%, and now 60% of GDP. If you travel enough and you go to countries like Sweden, and you go to some other countries in Europe and Asia, their number one concern is not non-financial corporate debt, it's household debt. Because they saw what happened here. And you can flip houses in Copenhagen and Stockholm like we used to do it in Florida. Now, so they're really concerned with that, and they're proactively, the central banks, but they're concerned. And remember Eric's comment today about his concern with commercial real estate. So it is a concern to me. The bottom line is, and this is not something that I've done too much beyond work, is that in 1997, global debt was 217% of GDP. It's gone up by 100 percentage points, 318%. $244 trillion of debt out there. And what's going to happen if we have a global recession? That debt has to be repaid. And countries borrowing money are going to find they're being crowded out by the very, very good countries. And there's going to be more sovereign defaults and certainly more corporate defaults when we have the next recession. And finally, this is a slide for another presentation, but has to do with applying the z-score for a number of applications. The only one I want to talk about is comparative risk profiles over time. How similar or different are we today than in 2007? And the reason why I choose 7 is because it was a year before the crisis, and it was risk on, big time, even though there were indications of problems. And so here's the question I'd like to ask you, and I ask myself. Is today's high-yield company more or less or about the same credit-worthy than it was in 2007? You got the question? Today versus 2007, is the average company more or less credit-worthy or about the same? So let's take a consensus of the audience. How many think that the average high-yield company today is more credit-worthy, less risk, than it was in '07? Today versus '07, more credit-worthy. Okay, 32. No, I don't know. How many think less credit-worthy? 2020. And how many think about the same? Okay, it's a good distribution. I would say more think it's less credit-worthy. Well, I asked the same question, and I said, well, I don't know. I've been reading a lot about how much cash is on the balance sheets of companies. I've been reading about their EBITDA coverage ratios being better. I've been hearing about how easy it is to borrow money, which means they should be creditworthy. So I guess I would think they would be more creditworthy, but I'm worried about the leverage ratios. And in some industries, and you know which ones they are, have real cash flow problems and could have dramatic cash flow problems if we go into a recession. And so rather than speculate and wave my hand one way or the other, we decided to calculate average z-scores in '07, in 2012, 14, and the last time we did it was 2018. And here's the old model. Some of you remember it. Some of you have nightmares about it. But this has been with us for 52 years, or 51 years. And it's still being used, and it's maybe abused in some cases. But it's out there, and it's totally objective. There's no opinion. It's a number. And you calculate it then, and you calculate it now, and what do you get? So the way we look at it is, first, bond rating equivalence. So the last time we did that is 17, AAA, AA. Incidentally, how many AAAs are left in the United States? 2. At least, Charlie said 1. Maybe I missed something. Microsoft, I don't know, was Johnson & Johnson after this? Did they get downgraded? I thought it was Microsoft and Johnson & Johnson. So it's either 2, unless Johnson & Johnson, because of the latest scandals, might be downgraded, but I think it's 2. How many were there 25 years ago? 99. So we're down to 2. So now we can't, it's not enough to have a number, so we had to combine it with double A's. So we've got 4.2, 3.8, 3.1, 2.45. So this is the median Z-score by rating. And notice it's more or less 0 for the average company that defaults. So 0 is a good one to benchmark, but also the bond rating equivalent. And here are our results. In 2007, the median Z-score, 1.84. There's another model I look at, double prime, which I don't have time, and today 1.98. Slightly better. Both B+ bond rating equivalent. So if somebody asks you at the bar tonight, what's the median bond rating equivalent of US companies that are high yield, it's B+. It's slightly better than it was back in 2007, but statistically insignificant. So the good news is it's not worse. The bad news is, statistically speaking, it's not better. And that was 07. And that's when, and now the stock market, by the way, one of the variables in the model is the market value of equity to debt, not book value. Imagine if we'd be using book value, how much worse the score would be today. So to me, it indicates not terribly great news. But it's enough to attract investors, particularly as many of the speakers this morning pointed out, risk on. And lowering interest rates motivates risk on. And so what Eric said is absolutely true. Why are we so enamored with lower interest rates? Are you going to buy a house if your interest rate goes from 3.5 to 3.25 or 3? You've already bought your house if interest rates is a factor. Yeah, there might be the marginal. See, I don't think interest rates dropping 25 basis points really has almost any impact. Maybe if it drops to 0, as Mr. Trump would like, that might impact. Maybe it's negative. That's why you get a mortgage out and the bank pays you. That's great. Wow. Then maybe I'll buy a house. Anyway, my conclusion then, and I'll end on this. I talked about, oh, by the way, if you want to look at Z-scores of triple Bs, today I think that between 30 and 40% of triple Bs deserve to be double Bs. But that's by a model. That's not me as an opinion because I don't know the companies. But that's what the scores say. They look like a bond rating equivalent, a double B or B. And the rating agencies that I've talked to, not KBRA because we haven't talked about it, say that if there is a recession, 5 to 7% of triple Bs would be downgraded. That's benign. If it's 10 to 20%, you're talking about an increase in high yield bonds of $600 billion to $1 trillion. The crowding out effect will clearly take place. How strong it will be has to do with how much refinancing the lower quality guys need to do. So in conclusion, the benign cycle is likely to continue through 2019 and possibly longer. The next stress cycle is likely to be deeper and longer because of the amount of leverage in the system and the difficulty in working out those leveraged finance companies. So the turnaround industry and the distressed debt industry is licking their chops as to the amount of activity they're going to have when this happens. Again, timing is a difficult one. The timing of the next crisis is likely to be concurrent with the next major downturn. That's why it's so important to forecast the economy, not only because of the election, not only because of jobs, but because of default rates. And finally, probably not as severe as the last one, unless the real estate market gets impacted as well. And remember Eric's comment? He's worried about that market, particularly the commercial one, part of it. So, bottom line is, 12 months from now, if we have another conference year or wherever, we might be saying it's on the verge of happening, but it probably won't happen yet in terms, unless there's some geopolitical crisis that changes things overnight. But when it takes place, we should be forewarned early enough to start cutting down the risk. And that's what a risk manager is all about. Thank you very much. Okay, since I'm my own moderator, oh no, we have a moderator here. Do we have some time for questions? Okay, so the rules are the same as this morning. If you have a question, please line up right next to the cameras, and Ryan and Sid will assist you. I see a lot of people heading for the doors. And there's no fire alarm. Any questions at this point? Oh, Ethan has a question every time, but they're always tough questions, so let's go to someone else. No, wait there. There's a gentleman over here.
Professor Altman, why do you think this current recovery has lasted so long? What do you think are some of the structural...
Why do I think the
current recovery has lasted so long compared to previous recoveries?
Well, first of all, you have to measure a recovery relative to what happened before the recovery. So we were at such a low point that, and by the way, the recovery hasn't been great. Now they're talking about 3%, 2%, 1.7% next year. I think partially is where we were. I'm not too excited about the recovery because productivity has gone in the opposite direction. And I think it's lasted mainly because debt is so cheap. You don't have to be a genius to grow a company or a country when you can borrow at almost nothing. How much do you have to earn? Do you remember the return on equity calculation that you all learned in corporate finance? A very big factor on ROE, not ROI, ROE, is leverage. And if you've got a lot of leverage, you don't have to have very much earnings to grow your profits. So I think it's a lot of leverage, and I'm concerned because of the lack of productivity. Ethan?
Your first slide, Professor, you had factors that would lead to default. One of them was yield. So my question for you is, how consistent is Fed monetary policy with credit default cycles?
Yeah.
So if the Fed's actually lowering interest rates, and you mentioned that before, that reduced some of the temperature, do you think that that's actually one of the most critical factors for a credit cycle?
I think it's more the anticipation of what the Fed will do that is keeping us fat and happy. The 0.25% interest rate had almost no effect, really, except controversy that it was politically motivated.
Right. But we raised interest rates by 250 basis points.
Yeah,
and that did not trigger any credit cycle while those numbers were growing up.
That's right.
So,
yeah, I don't know. I'm not a Fed watcher. I'm not an interest rate guy, to be honest with you. So I don't really know the elasticities over the, from 2.5% to 2% versus 1 to 1.5% or 1 3/4. But I think it has shown that it's what the markets reflect more on is kind of what they say after they change the interest rate, right? What's the outlook for the future rather than the interest rate change? And so I think, unless I'm mistaken, what Chairman Powell said was, we're ready to move again, but we need to see the numbers, which is, I guess, didn't say much except that whatever the numbers turn out to be. But the market wasn't that excited about that. And so that's why the stock market was flat.
we all laughed when you said maybe if interest rates turn negative and you get a mortgage and the bank will pay you. But you know, it's happening. In Denmark, several banks are actually paying their mortgage borrowers
Yeah.
because the negative interest rates, they're passing it on. And I guess if you can borrow from the ECB at 0.5 negative, which means the ECB pays you 0.5%, you can then turn around and pay 0.1% to your mortgage borrower. But if that's the future of the world, including here in the US, and we're all getting to negative rates, and then maybe this can keep on, maybe the cycle keeps getting longer,
Pushed out, yeah.
pushed out, although in the long run, that's going to have big damaging something, no? I mean, I have a hard time getting my head around negative rates and how, like, we all get paid to borrow, but
Yeah.
if we do, is that going to hurt something sometime?
Yeah, it blows my mind also. But you're right, it's happening in other parts of the world. It's ironic that the Central Bank of Denmark and the Central Bank of Sweden is worried about household debt, and yet interest rates are negative because the pressures from other countries within the ECB is overwhelming their risk aversion. So, by the way, I have the same concern. And, you know, there's a lot of costs. I'm not sure who talked about it this morning, but there's a couple of people. There's tremendous costs to low interest rates and negative. How are those pension funds going to fund their liabilities when they can invest at, you know, 1% or 0.5%, especially if they have a risk tolerance that's very low? So they buy investment grade debt, they get 0.5% or 1% above the risk-free rate. And then those poor folks who take out life insurance, and by the way, the life insurance companies, they're not lowering their costs that they deduct from your premiums, right? Your premiums are, you know, maybe paid in advance or they stay the same, but the cost that they charge you remains pretty high, but their investment returns go down unless they had been a lot in equities. And so those poor folks, and I consider myself part of them, when those, you know, when we pass on, there may be no insurance because there's nothing left. It's all been eaten up by the insurance costs minus the rates of return, especially on a flight to quality when the returns go. So I'm very concerned as well. One more question or two more, and then we'll go end it.
So I wanted your, I guess, view on this comment that I had heard from someone else. So in the kind of previous cycle, the leverage was on the consumer side, whereas now the leverage is on the corporate side. And so, you know, what this person was kind of contrasting is that, you know, corporations, especially large BBB companies, have a lot of options to avoid downgrades or distress. They could cut dividends, buybacks, divest assets, and then when they emerge out of bankruptcy, they still have access to relatively cheap financing, but that's not the case with a consumer emerging out of bankruptcy.
Yeah.
So a lot of the commentary, or some of the commentary, has been that the next downturn could be a lot more severe than the past one. So, I mean, how would you kind of reconcile this kind of view?
Well, I agree that the next one will be longer and deeper. I don't know if severe is the right word in terms of GDP. I kind of think it won't be as bad unless that real estate market tanks as well. And I'm no expert on real estate, but what I know about New York City is now there's a lot of softness out there, particularly in the high-priced condos, et cetera. And huge amounts of real estate in New York are vacant now. I mean, vacant, there's owners, but they're not living there. And so, and there's no turnover and whatever on those. Except lower prices are a little bit better. So I'm concerned also with the consumer market, by the way, rather than, but I'm really concerned with the commercial market, which is commercial debt. So these are other people who made the comments. I think are fairly consistent with my conclusion that because of so much debt out there and the inevitable, we don't know when, recession, the consequences are going to be huge. I just don't know when. So I'm more bearish than most of the speakers this morning, not as to when the recession will take place, because I don't really know, but what will happen when it takes place. The saving grace is the quality of the banks. They're much higher today. And so from a systemic problem, I don't think it's going to be as severe.
And look like the playbook for the central bankers globally are very simple. Number one, they lower the interest rate, it could be negative. Number two, by all the assets they could get hand on, so all the junk bond will be bought. And three, they will issue 100 years old bond and look like problem solved. However, the only concern really is the fiat currency.
Okay, Professor, you're next.
Thank you.
Thank you very much.